Well, good day, everyone, and welcome to an FS Club seminar, this time on possibly a subject very, very dear to your chairman's heart. For those of you who don't know me, I'm Michael Mainelli, and I'm joined here today by Julian Enoizi. Julian is the CEO of Pool Re, and he's here today to talk about Resilience Re, designing a public-private response to pandemic and other systemic risks. So what we're going to do today is fairly straightforward. We're going to be having Julian present for about 20 to 25 minutes, and then we'll have hopefully a very vigorous discussion. The discussion, of course, is only possible because we have a fascinating and wonderful group of sponsors. You can see our sponsors before you here. They range widely and freely across technology, economics, and finance, but we're particularly delighted to have them all here because today's subject should be dear to all of us. It's about how we as society protect ourselves against the big risks that are out there. The format is before you today in the sense that we're going to have me get out of your way as quickly as possible, Julian do his talk and then the Q&A, but please do use the question and answer facility within the GoToWebinar application in front of you. The reason I say that is if you email me, I will get your question, but not in time to feed it into the conversation because I'm here with you right now. And then just briefly, if I might, on a personal note, I'd like to say that one of the things I admire about Julian, you can read all of his biography and everything online, as you know, we don't do long intros here, is that the subject he's talking about today, he has been passionate about for nearly a decade as well. So he's not presenting a response just to COVID-19. This is a project that he's been working assiduously on for some time. And my personal interest in it is that I was around in the founding of Pool Re back in 1992, before Julian was involved, when we were trying to help a number of people move to the city, but we couldn't get terrorism insurance because there was no reinsurance market. And we've also been doing a lot of work, as many of you will know, on a cyber catastrophe public-private insurance area, as well as a public-private education mutual for universities. So Zien has been involved in these areas for ages, as well as the establishment of the clinical negligence scheme for trust. But what Julian's going to be looking at today is the whole shebang, the complete package. And I think this is a really, really important session for us and something that we in the UK have done very well historically. Perhaps we can do well again. Julian, the floor is yours.
Thank you, Michael, and real pleasure to be here with you. As you've said, really what I wanted to do was to talk a bit about managing systemic risk, and I'm going to do that in the context of what Pool Re does. So I'm going to spend a few minutes talking about what Pool Re does and the history of Pool Re and how it evolved, why it evolved, and how it works. I'm then going to talk a little bit about current crisis, the current systemic event, and the difference between a systemic event and a CAT event, a catastrophe event. Then talk about what response the UK has had, and then I'm going to finish looking beyond just terrorism or pandemic and actually into broader other systemic risks that are on the horizon and how those might affect us. So if you move on a couple of slides, please. I'll start, as I said, by looking at a sort of market failure event, because every now and then, unfortunately, you will have events which are just bigger than society, the insurance industry can cope with, and you're seeing that right now. You saw it in 9/11, which would have been described at the time as an existential event, and in the UK, we had that in 1993. Where the insurance and reinsurance markets basically withdrew their capacity. They felt that it was no longer possible to insure the events that they were being faced with because they were happening on a daily basis. And the problem with that was, of course, you end up with a threat to the economy because if you can no longer purchase insurance for, in that case, terrorism, then banks stop lending money, construction projects stop occurring, inward investment into the UK stops happening. And of course, the government at the time couldn't allow that to happen. And so they formed in partnership, and I stress that word partnership, with the insurance industry, Pool Re. And the idea was that it would allow the insurance industry to continue to operate and offer terrorism insurance, which would allow the economy to continue to thrive. If you look at the amount of assets that Pool Re today insures, £2.2 trillion, what you had with terrorism at the time was a risk that you could no longer model. There wasn't the kind of models that we have today that allow you to model severity of the risk, so actually modeling blasts, and there weren't certainly the ability to predict frequency. You could have gone back as far as, say, Guy Fawkes and sort of looked forward at terrorism events, but that wasn't really going to allow you to calculate frequency. And frequency and severity are the two elements that you need to calculate an insurance premium. So if you flip to the next slide, please, Michael, you'll see that really what Pool Re was intended to do was to protect the UK economy, but it was also intended to provide a safety net for insurers, because insurers wouldn't have exposed themselves to a risk that they felt was going to effectively bet the farm. In other words, it would have been them putting their capital up against a risk that they couldn't model and therefore could have caused them to go bust. But at the same, excuse me, at the same time, what you had was a policy objective that the government was trying to achieve, which was that business was able to access available and affordable insurance product, which was, of course, then facilitate the continued growth of the economy, a continued inward investment. But the idea at the time, as it is with the sister company Flood Re that was formed a few years ago, was that over time the market would learn how to do this risk and would bring it back therefore into the private market, and the government would slowly recede into the background. And I'll show you how that happens in a second. But part of the need for that was to bring different capital sources into the risk, also understand the risk a lot better than we currently do, and also to partner with government in understanding what the threat is and how that evolves. And if you go to the next slide, you'll see that this isn't a unique thing to the United Kingdom. There are a number of these different types of mechanisms that occur around the world where risk is too big for the insurance industry to cope with. And so government has to step in some form. And how government steps in differs often according to the political expediency of the country. So United Kingdom, United States, in regards to terrorism risk specifically, the government is looking for a private market solution as opposed to simply what you get in, let's say, France or Spain, let's say more socialist countries where the government tends to operate more as a nanny state and take the risk onto the government's balance sheet and effectively recoup the money by charging a tax, a levy on every insurance policy sold. In the United Kingdom, we've tried much more for a private market solution, which I will demonstrate on the next slide. But just before I move on, you can see here that in every country, you will see these things for different risks. So whether that's flood or whether it's weather events, and that could be drought as well as flood, it can be earthquake, it can be wildfire. The California Wildfire Fund just set up literally last year in the wake of those wildfires. Livestock, for those of you that remember the foot and mouth disease 10 or 15 years ago, et cetera, et cetera. So this is not a unique proposition. It's just a question of how government moves into. But what I will say that these things share in common, two things. One, they were always set up after the disaster struck. And two, none of them have ever succeeded in returning the risk entirely to the private market and winding themselves up. And I'll come back to that in a moment. So if you flick to the next slide, what you see is that part of the rationale for moving this to the private market is that on day one of formation of any of these, let's call them protection gap entities, is that the government is effectively carrying the entire risk. In 1993, the government was effectively on the hook for terrorism risk because there was no insurance market. But what's happened over time is that the financing of the risk has got better and better. And so what you see now is that the pooling mechanism, and over 27 years, Pool Re has handled 17 different terrorism events, and it's built up a fund of money to pay for future terrorism events. But what it's also done is it's persuaded the private market to return to the risk, and it's done that in a number of ways. One, it's influenced the consumer of the behavior, the behavior of the consumer, so that the consumer recognizes their risk and takes steps to mitigate it, and that can be, by putting concrete bollards in front of a building, or by putting, blast-proof coating on your glass, and therefore you get a reduction in your premium. The insurance industry over time has, through modeling techniques and understanding of the threat, taken on more and more of the risk and also retained more and more of the premium. The reinsurance market has come back to play in this after 25 years, and you can see there that £2.4 billion of reinsurance capacity deployed. This is the world's largest terrorism deployment of capacity. And then on that right-hand chart, you can see a very small box, 75 million pounds worth of capital markets. In other words, the capital markets, your and my pension fund, have invested at a very healthy coupon rate into this risk and begun to understand it. And I can tell you that that terrorism bond, which we placed 18 months ago, is now the most highly traded catastrophe bond in the world. So what you've created is a marketplace for risk that 27 years ago nobody wanted to touch with a barge pole, and today the taxpayer is about £10.1 billion away from ever having to pay for a terrorism risk in the UK. That is successful by any measure, because it insulates government, insulates the taxpayer, and essentially makes the government a tail risk carrier today versus 27 years ago on the left-hand side, where you can see it was essentially a ground-up reinsurer. If you flick to the next slide, you'll see that what this means is that the pool re has become a critical component of both the financial city and also the governmental infrastructure. It's carrying an awful lot of risk itself, £2.2 trillion worth. It's actually managing to put some of that into the private sector. It's raising money for investors, it's increasing investment in risk mitigation. But what it's also doing is investing a lot of money in what I would call risk modeling. So one of the things that we now do much better than we've ever done in the past is blast modeling. So we can look at blast modeling for conventional type truck bombs, for CBRN type events, even for cyber type events. And we can look at the blast not in 1D or 2D, as was the case up until a few years ago, then 3D, but now actually through computational fluid dynamics, we can actually watch how a blast propagates and what damage it will actually cause. And that allows people to manage the amount of risk that they've got and to buy the appropriate amount of insurance and reinsurance. Equally, the issue of severity remains the holy grail. I mean, it's without that proxy for being able to calculate severity, you're never going to have a truly private market. But by doing a lot of that work on behalf of the insurance industry, we have been able to give them a lot more comfort, and they have therefore tried to price this on a more risk reflective basis because they have a far greater understanding of the risk than they did 27 years ago. And if you flick to the next slide, what you'll see is that that success is now being recognized not only by the insurance industry, who put their money where their mouth is by carrying more of the risk, but also the government, who recognize that pool re is actually a very good example of public-private partnership. In other words, the guarantee that the government gives the industry isn't just being wasted, it's being utilized to actually create a profit opportunity for the insurance industry, whilst at the same time distancing the taxpayer from the loss. And that is something that is in the interests of all parties. The other thing that I think pool re does well, if you look at the next slide, is that it has evolved over time. In other words, it's not static. It doesn't look the same as it did in 1993. In 1993, fire and explosion was typically the modus operandi of terrorists. But if you look today, you can see that over time, we have reacted by adding new risks. So chemical, biological, radiological, and nuclear. You've only got to think of what happened in Salisbury. Although that wasn't terrorism, you can see the impact of radiological material. Cyber trigger has been added because we see that cyber damage by cyber trigger is something that we need to be cognizant of. And of course, very prescient for what's happening today is often these losses are caused where there's no physical damage. And so NDBI stands for non-damage business interruption, which is precisely what you saw at London Bridge in 2017, where there was no physical damage, but an awful lot of non-damage business interruption when London Bridge Borough Market was shut for 12 days because there was a police cordon thrown around the area. And of course, what you've seen in the last few months is no physical damage, but all these premises shops up and down the country shut, unable to trade. And so non-damage business interruption. And if you flick to the next slide, you'll see that in the context of terrorism, the threat continues to evolve. 27 years ago, we were worried about Irish republicanism. 10 years ago, we were worried about Islamic extremism from Al-Qaeda. Then you switch to Islamic fundamentalism in the shape of Daesh, which is a low sophistication model as opposed to a spectacular model that Al-Qaeda deployed. And today you're looking at all sorts of different things in terms of climate activism, far-right extremism, and of course, possibly domestic terrorism in the shape of the Black Lives Matter movement. Donald Trump's words, not mine, but you can see where these things are going. You've also got mass migration caused by climate change, which is causing huge population shifts, world poverty, all of which then makes it more easy to radicalize people, which gives rise to terrorism. But not only the actors are changing, the vectors are changing. And so you've gone from conventional, analog to digital terrorism, now to cyber terrorism. You've got the advent of drones, you've got the advent of CBRN weapons. And of course, the thing that worries me a lot is, whether terrorists are learning from what's happened from a COVID-19 scenario. Imagine if they were able to do something like that in the biological world. To finish on terrorism, flicking to the next slide, I think what we look at here are the various partnerships that Paul Ree has enjoyed with government. It's a public-private partnership. And as I always say, it's in fact a three-legged stool, because the work that we have done with academia has allowed us to really understand and model the threat far more than we did 27 years ago, far more than we did 10 years ago. So our understanding of the risk, the threat actors, the threat vectors is far greater due to our work with academia. Our work with government means that we understand policy far better, and we're able to liaise with people like JSARC, the Office for Counterterrorism, Metropolitan Police. And in fact, one of the things that we're doing a lot of now is investing some of our premium income, and we have about 6.4 billion, you can see that from the previous slide, into risk mitigation projects so that we're able to actually mitigate the threat from terrorism as opposed to simply sitting on a pile of cash and waiting for the loss to happen. With that, I'm going to move into the issue of today, which is really COVID-19. So if you flick forward 2 slides, Mike, another slide, what you'll see here is really the similarities between terrorism and COVID. But I'll start with the fact that the industry, of course, is already struggling with COVID, because in hindsight, what the industry said was, well, we never intended to cover pandemic. And realistically, had they intended to cover an event like this, they would have been charging an awful lot of premium, or they would have been sublimiting the losses, or they would have been narrowing the wordings. The reality is I suspect a combination of sloppiness and sloppy wordings has meant that you've now got this situation of uncertainty and litigation that is going on, which is, of course, not good for anybody. And you can see some headlines there. And if you flick to the next slide, you'll see the industry's response to this, which is to say, look, if the Chancellor of the Exchequer is pumping hundreds of billions of pounds into this, and the GWP, the gross written premium of insurance in the United Kingdom, is 18 billion pounds, you can see that the industry could never have intended to have covered an event like this. To which your response might be, well, then it should have said that in its wordings, and it should have been clearer. And I suspect that will be one of the major lessons to come out of this. That being said, the industry is now, of course, turning its attention to what happens if this happened again. Because if it were to happen again, you better make damn sure that your wordings are absolutely watertight and are absolutely excluding any kind of loss like this. Well, that leads you to exactly what you saw in 1993, market failure. Because if you want to purchase an insurance product for a pandemic or for some kind of human communicable disease or for non-damage business interruption that arises from that, you will not be able to purchase that however much money you want to spend on it. And therefore, you've got a problem. And you can see here a range of commentators, Deputy Governor at the Bank of England, Select Committee MPs, and Stephen Catlin, who's a bit of an industry icon in this, all talking about the industry capitalization globally is not sufficient to cover an event of this magnitude. And the only way you can cover an event of this magnitude is one of two ways. Either the government does it, and the government, of course, as insurer of last resort, is currently the largest insurance company in Britain, or you do something akin to what was done for terrorism and create some form of public-private partnership in order to do that. So again, if you flick forward 2 slides, Michael, I will just briefly show you what the response in the UK so far has been to this. The first is Pandemic Re, imaginatively named, and Stephen Catlin, who you saw a couple of slides ago, is leading an initiative to look at a public-private response. And whilst I think they decided to start with a blank sheet of paper, I think what they quickly came to the conclusion was, in Pool Re, for managing terrorism for commercial enterprises, we have a pretty good model. And it would be foolish of us to just simply reinvent the wheel if we have something that works pretty well. But of course, the numbers that I showed you, £10 billion for a terrorism event, which cover pretty much 98% of modeled losses for terrorism, dwarfs into almost insignificance when you think of that in the context of what we're seeing at the moment in terms of pandemic. And so the question that's polarizing the industry is this something that the insurance industry can really get into, or is this something that should be left simply to government and therefore the taxpayer? And I'll come on to my views on that in a second. But Pandemic Re is very definitely focused on a public-private partnership response to the current situation. And as I said earlier, it always happens post-event as opposed to pre-event, which is unfortunate. There are a number of other initiatives. I'll gloss over the first, but the last 2 are essentially saying, well, hang on a minute. If we deal with pandemic, aren't we leaving ourselves open to other forms of systemic risk which may occur in the future? Because the next virus may not be a physical one, but it may be a computer-generated one, and we could find ourselves with some kind of systemic cyber attack or an outage of the national grid, and we're back to square one. The reputation of the insurance industry will be in the toilet once again. The government will have been seen to be responding post-event, not pre-event, and actually there's an opportunity here to respond to these things before they happen as opposed to after they happen, and that's the genesis of both Totus Re and the Lloyd's generated Black Swan Re. If you look at the next page, I think what you're seeing, and my own personal view, is that I agree with the view that we should be looking at a broader umbrella type approach to managing risk as opposed to dealing with them on a piecemeal approach, because what you're seeing in pandemic is a non-damage business interruption. And unlike with terrorism in 1993, where it was the City of London that was the focus, it's the backbone of the economy, namely the 5.8 small and medium-sized enterprises, 5.8 million of those that are suffering because they've been shut down. And so what response can you give them? And so if you look at this slide, what it's seeing is the sorts of things that we would expect a public-private response to look like in this situation. It should cover all businesses, not just small and medium sizes. It needs to encourage businesses to purchase the cover, which means it has to be affordable. But there are also regulatory issues there about whether it should be a mandatory cover or at least mandatory to offer the cover. Because if you are a small business today, having been bailed out by the government, the chances are you're not going to want to buy an insurance product because your view will be, why would I? The government will bail me out. It has to have private market participation, in my view. If the insurance industry vacates the space that has been left by pandemic, then it will be very hard for it to remain relevant in future. It will be hard for it to persuade customers that they should buy insurance products which only respond to the things that the insurance companies feel that they can model and price and therefore want to expose themselves to. For those things that they can't model and price, they need to find different solutions, and some sort of public-private partnership, a pooling mechanism, is a way of doing that. But to say to the government, you're on your own, we're not doing this, is wrong in my view, because what the government needs are two things. One is a distribution mechanism to pump liquidity into the economy post-loss very quickly, and insurance can do that, and also a way of recouping the money post-loss, which it can do via insurance and future premiums that are charged for that product, as opposed to what we'll probably see in the UK now, taxation. It also has to have risk mitigation incentivization. We have to be able to say to people, look, you've got to manage your risk better so that if this were to occur again in the future, you are prepared for it and your business can operate in a different way so that you're mitigating your own risk. And you've got to obviously have quick claim payment. So switching through to the next slide, and I'll try and finish this off fairly quickly now so that we can move to questions. We obviously believe that Pool Re is a good mechanism that could do this, but this isn't an advert for Pool Re, and so I'm going to move on 2 slides to just finish off with a few comments. We do believe Pool Re is well placed to do this because it's an existing mechanism. The 30 people that work with me are specialists in systemic risk. It's all we do all day long, is thinking about what sort of model, how do we disaster risk finance, how do we disaster risk manage, how do we model these losses, how do we price these losses, how do we get to risk reflectiveness in that pricing. This slide, however, shows you the 2017 National Risk Register, and the most striking thing that I'm sure you'll have all read in the papers is that pandemic influenza was right at the top of this, and why are we so poorly prepared? But what it also raises the question in my mind is why the government doesn't make use of the tool of insurance in managing some of these risks, which ultimately are simply sitting on its balance sheet. You saw that with the foot and mouth disease, where the government had foot the bill for that. You're now seeing it with pandemic influenza. You would see it with systemic cyber, because while cyber products are available, they're not ones that would cover systemic sides of this. And so the question is, if we have a national risk register, flicking now to the next slide, why wouldn't we have a way of managing risk on a national basis? In other words, why wouldn't we have a national, for want of a better word, insurance company? If the intent and aim of that is resilience in the British economy, then why wouldn't we call that Resilience Re? And why wouldn't that have a number of different pillars sitting underneath it? Terrorism would be one, nuclear terrorism would be another, pandemic could be another, cyber, climate-related risks, etc., etc. And so what you create is a Resilience Re that benefits from that unlimited government guarantee that we currently have, but that the insurance industry has skin in the game through the policyholder excess, the retention by the member insurers, reinsurance purchasing, insurance-linked securities, etc., etc., and that there is then underneath that the behavioral influencer of risk mitigation, so that you actually build up a picture of resilience from the customer who's taking steps to mitigate their own risk, incentivized by cheaper premium from an insurance company, which in turn has mutualized that risk through a pooling structure, which in turn benefits from a government guarantee when all of those things are exhausted. And if you go to the last slide, I think I have 1 minute left. Everybody benefits. UK business benefits because it's got reduced premium by dint of the fact that it's guaranteed by the government. The premium will therefore be affordable, but it's also got comprehensive insurance. There aren't going to be these issues that you're seeing today with this litigation in the High Court about what's covered, what's not covered. You've got a comprehensive, affordable protection against the disasters that could strike. And that, as I said, doesn't necessarily need to be limited to terrorism or limited to pandemic, but could be a broader systemic set of cover. The government, of course, benefits because it's providing a government guarantee, but it's monetizing that guarantee and being paid for the provision of that guarantee. We pay the government £200 million a year for terrorism. That would presumably be more if you were to create these different diversified risks. You would be reducing moral hazard because people would be forced to buy these products because they would not rely, therefore, on government bailing them out. You'd have increased national resilience. And then, of course, for the insurance industry, it wouldn't be betting the farm and risking insolvency if it gets it wrong. It'll have a solvency guarantee. It'll have a stable industry that's able to be relevant in providing products that matter to the customer going forward. And I think, Michael, I'll stop my comments there. Thank you.
Julian, that was a wonderfully cogent exposition in a very tight time frame. I really appreciate it, and I think the audience does too, given the board is lit up. Lots of praise, brilliant. One person wants to vote for Resilience Re. Well, you may have skipped over the second of the 4 initiatives. I must say, I thought Recovery has probably got the best name that was there. And I was also, I just want to emphasize, it was a question I was going to ask you, but you covered it. But just to emphasize, you really do work with a team of 30 people. This is not a big bureaucratic overhead. It's really using market forces effectively. And I just want to emphasize that to the audience. Anyway, they're not here to hear me, they're here to hear you. I'll probably start with an easy one, if I might. Will there not always be risk events that private insurers can't deal with? And then a kind of an odd thing from Mike Clark, wondering, looking at your slide where you talk about multi-perils, are the French actually better placed than Britain?
Yeah, look, it's a great question, and it's really 2 questions, really. I mean, will there always be multi-perils? Yeah, I think there will be. But I think if we are to avoid the situation that we've experienced over the last few months, then a resilience type structure, to my mind, provides the government at least with an infrastructure to manage the national risk register in the same way as a company manages its risk register. But to your point on the French and the Spanish, I mean, the CCR model in France, the Consortio model in Spain are fantastic models. I mean, please don't get me wrong. If you look at, let's take Spanish Consortio, if you're in Madrid, you're worrying about terrorism risk. If you are in the Canary Islands, you're worrying about wind risk. And by the levy that is put on your insurance policy, what you're effectively doing is each location is cross-subsidizing the other. So the Canary Islands are cross-subsidizing the affordability of terrorism insurance in Madrid, and the Madrid residents are cross-subsidizing the affordability of wind in the Canary Islands. The problem with the model, problem in inverted commas, the downside or the weakness, if you like, of the model is it effectively creates the nanny state. Because there is no private market involvement. The private insurance market, reinsurance market, capital markets do not participate in that risk. It is a pure tax administered by civil servants, no disrespect to the civil servants, but they're not insurance professionals. And so really all you can do is increase and decrease the size of the levy according to how many claims there are in a particular year, as opposed to risk manage, risk mitigate, and risk model.
Interesting, but you and I have beat our heads with some success, but frequently gone home and nursed a sore head against the government in trying to get some of these concepts across over many years. Yet we are seeing some interesting signs. I would point to the collective defined contribution benefits, which featured on a webinar earlier this week, as a sign that the government is beginning to understand the collectivization of risk, but also the management of it. Bob McDowell asked a really interesting question: regionalization, cities, states, and the current, leveling up model. Perhaps people like you and I should be focused on this regional example. Is this an area where we could do your Resilience Re for a region or for London, as opposed to having to do it nationally?
Yeah, I mean, it's a really interesting question. And before I answer the question or attempt to answer the question, I'll just make one other point. EIOPA, which is the European, you'll know what it stands for better than me, but essentially the pension fund, has actually come out this week and suggested that there would be a EU-wide Resilience Re. Well, no, EU-wide pandemic Re. So in other words, they've gone the opposite direction and basically said, let's have the entirety of the EU fund a pandemic Re. Now, I find that fascinating because, normally what happens in these situations is the British government says, well, I don't want to pay for a pandemic that occurs in France. And the French government says, well, I don't want to pay for one that occurs in Italy. But clearly they've seen something about the size of this risk and the ability to get different nations and economies back up and running, that they've gone for the opposite approach. But if you are a local authority, regional authority, and you've got your budget from government, I think those budgets are under an enormous amount of pressure because they're always being cut as far as I can make out. And therefore, what do you prioritize? Are you going to prioritize the purchasing of pandemic or terrorism insurance over, a new set of books for the schools? But what I think we need to do as an industry, and what local government and government needs to do, is to disrupt the current model of risk transfer and start to think of different ways of risk transfer. And so that question may well be one where pools of local authorities decide to pool whatever money that they have for managing risk together in a smaller form of this, so that they're able to purchase and leverage insurance purchasing themselves.
Just to be clear, at the moment, pool re is UK only. And have you ever thought about writing risk outside of the UK, or your remit doesn't permit that?
Our remit doesn't permit it, but some of my sister companies around the world do exactly that. They will diversify their risk, because bear in mind the diversification risk is what makes insurance and reinsurance cheaper. Some of my sister companies around the world do exactly that. They will reinsure. I buy reinsurance from 2 or 3 of my sister companies around the world. If you actually look at the nuclear liabilities scheme that was set up in the 60s, that actually, they all reinsure each other. So we, the British, reinsure 20 other countries around the world, and they in turn reinsure us. It's actually not a silly idea.
Now, a couple of people would like to just understand better, tease apart things. So Charles Vermont points out that the insurance industry doesn't cover war or civil war in the UK. Why do you believe pandemic is different?
That's a huge question, by the way, because of course, 100 years ago when the exclusion for war was written, it essentially referred to, essentially parking your tanks on my lawn. It was a physical declaration of war, followed up by an invasion of territory. Today, war, of course, doesn't happen that way. In fact, I think the last time war was declared was 1940 or 1939. The Falklands War was never a declared war. And I think, the Americans have certainly not been at war since the Second World War either. Moreover, if you look at what happened in Salisbury to agents of the Russian state, arguably, is that an act of war? So the definition of war in itself is a whole big question, which I won't go into here. But why is pandemic different? I think part of the problem is that the insurance industry was designed to cover physical property. If you look at what now businesses are concerned with, not only the non-damage business interruption point that I pointed out, but the vast majority of assets of businesses are no longer physical property. They are intellectual property, they're intangibles, brand, reputation, supply chain interruption. These are difficult risks to insure, I accept. But unless we as an industry find ways to participate in those risks, then I think over time we just become irrelevant, don't we?
Now, another issue that recurs with schemes like this and with many mutuals is compulsion. So Lloyd Greenside is curious, do you think that, what's the critical mass? Does it need to be a legal requirement? Tanji Morgan points out that when you're looking at risks in this field, terrorism and flood are events that are physical damage and usually occur in a specific geographic area where you can get a handle on it. But as you've indicated, pandemic and systemic risks, to make these products affordable, you've got to have the spread, but it doesn't need to be mandatory.
Yeah, and I know Tanji well. She's obviously from one of the regulators, and I think to me that is a fundamental question of if you look at the penetration rate in terrorism, and I referred to the 2017 event in Borough Market, the take-up rate of terrorism amongst small businesses is single digit. It's less than 10%. And so The question becomes, do you accept the moral hazard that then comes post the event? So post 2017, there was a meeting in Borough Market where the then small business minister went along to Borough Market, and we were very clear with them that if they agreed to bail out those small businesses, effectively nobody would ever buy terrorism insurance again. And so the question becomes, should you mandate the purchasing of these kind of insurances? And I think we have to be realistic that, you know, if you did mandate them, I think you would end up with a very large pool of premium very, very quickly. But the reality is the British government is highly unlikely to do that. And so the alternative is what we call mandating the offer of the insurance, which avoids that moral hazard. Because if I offer you a product, and I say, here is your product, it's going to cost you £30 to purchase this product. And if you buy it, it's going to cover you in all of these eventualities. And if you tick the box to say, no, thank you, I don't want that, well, after the event, you can hardly then claim compensation from the government because you were offered a very affordable, very comprehensive product. And so mandatory offer is probably more where I would focus my efforts. And I think in the US, mandatory offer results in about a 60% take-up rate, which is pretty good, as opposed to, as I said, our single-digit product.
And there are lots of sectors like startups where this is probably just inappropriate. You got to get the business going in the first place, or at least in most circumstances, one would argue. So I think, yeah, mandatory offers a very, very good message there.
But I'll just make one other point, sure, Michael, on that. And that is that one thing, again, for the regulator to think about, if I start saying, well, here's my terrorism product, and here's my pandemic product, and here's my cyber product, and here's my climate product, small businesses will never buy that.
Yeah, no,
so we have to overcome the bundling issue as well, and figure out a way where we can offer a single product that provides the cover for this, as opposed to asking a small businessman or woman to buy 5 different products, which is never going to happen.
And that's one slice on the wrist. There's a couple of questions here on the other one. Trevor Hilder and Bob McDowell sort of asking the same thing. I mean, how about doing this at several levels of recursion? You know, what would the merits be of like a sequential pool 1, 2, 3, 4 to kind of look at this by a size? Because you were looking there at the SME market being inclusive. Any thoughts on that quickly?
Yeah, I mean, look, again, the French terrorism model is a good way of looking at it. They basically dissect it by small business and large business. So they charge a different price for the small business. They make it different terms of conditions. And they have a much higher take-up rate in small business than we do, because big business isn't the problem. Large businesses buy these kind of products. If you had a product for pandemic, they'd buy it. The other way you can bifurcate it is in the cover that you provide, because you could say, look, you know, the addition of, I don't know, CBRN makes the product a lot more expensive. If you want, you can buy this in 2 forms, and we'll bifurcate the cover and take out the CBRN element, and that'll make the product even cheaper, as long as you understand what it is you're taking out. I don't know enough. I'm not a scientist enough to know about pandemic, what the equivalent of that is, but, you know, there are ways of slicing and dicing, which need further work.
We have an participant here, Madeline Moon is online, and she's asking, have you had any engagement with the devolved administrations? But an earlier question, really, how quickly do you think such insurance could be covering pandemics, given that people are looking at waves 2, 3, what have you? Is this realistic that we're going to see something this side, or is this current crisis too late?
I think if you wanted to do something for this current crisis, you would have to do something very quickly to essentially temporarily expand the remit of an existing entity. I think to start a new entity from scratch would be almost impossible. And also, I think, let's be realistic, the insurance industry is highly unlikely to take on even $1 of risk for an event that is already underway. And so realistically, you would have to have the government pretty much backstop this 100%, and you would essentially be using the insurance industry as a distribution mechanism and as a recoupment mechanism. So yeah, I think you could do it quickly, but it would have to be in the same way as 93, Paul Re was set up in 3 months. I think you'd have to do it with an existing entity. Whether we've had discussions with devolved administrations, is that what you asked me?
That's right.
No,
Okay.
we've obviously had discussions with some of the regulators, with some of the central government, but not with regional administrations.
A few people are going to have to draw things to a close soon because the board is absolutely full, and I'll send you the questions and comments afterwards so you can respond to people if you wish. But one of the things that a lot of people are asking about here is the climate risk. That too would show up on this risk register. Is that a category that you would put into your resilience RE?
Yeah, I mean, look, some climate risks the insurance industry deals with very well, and that's that distinction that I drew right at the beginning between catastrophe risk, which the insurance industry deals with because it can model it can calculate a risk-reflective premium, and there's enough capacity to deploy. Systemic risk is very different, and so individual climate risks like a flood or a windstorm are modelable. But I think when you get to thinking about the overall impact of climate change, just like aging population or long-term healthcare, those require a different way of thinking about the risk. And I think that can only be done in conjunction with government because there's a policy objective that needs to be achieved as well as an insurance.
Now, we have a number of questions, but I'm gonna do something unusual, I hope. I'm going to try and answer a question for you, and then I want you to correct me, okay? Because I think it's a great question to end this session on. It's from Hugh Morris, and then he's asking, how does Julian envisage that private risk capital can help events at the scale of COVID-19? Won't nation states always end up shouldering the majority of the financial burden when risk catastrophes of this scale occur? And I would answer this as saying the whole purpose of Resilience Re is not to play with the financing of it per se. It's actually to give government the tools to help everybody manage a risk that is already on the government's balance sheet. Your correction, please.
I'm hardly going to disagree with the eminent professor. No, I think absolutely spot on, Michael. I would just make one subtle observation, and that is that 27 years ago, there was £0 in the bank to deal with terrorism risk. You have to start somewhere. And, yes, I agree, the current crisis has demonstrated how big this is, but let's hope that these aren't annual events. And also, if you add more risk into the Resilience Re, you get that diversification, increased premium. Eventually, you get more exposure from the capital markets and the reinsurers. And so financing does occur, even if it's to a limited extent.
If we have more time, I mean, Ben Koppelman would be interested in how you could use this insurance to help the take up of some of the track and trace applications. Could this type of insurance incentivize that sort of thing, which I think we could go into. Hugh Purser is very interested in how would you apply your blast modeling experience to business interruption and pandemic experience. So a lot of questions out there. But sadly, I'm also getting many nice comments about your presentation, which means it's normally a sign that I have to bring it to a close. So if you could just hold on a second, I've got 3 rounds of thanks to give. The first one, quite naturally, is thanks to our sponsors. I hope those of you who are online have enjoyed this. Julian has certainly brought together technology, economics, and finance, all there and all about risk. So well done to that. And I thank you very much for allowing us to range, as you do, widely and freely across the sector. I'd also point out we do have a number of webinars forthcoming next week. An interesting one talking about what lockdown has been like for people managing employee share schemes. I'm going to have a fascinating session with Edmund Fitton-Brown. That's going to be very much about security. If you read Edmund's background, you'll realize this could be a really interesting global security talk, and a very different one for us, very focused on climate change and biodiversity loss, etc. An old friend of mine, Mark Schlossman, is going to be talking about a very special project on history specimens. It's much more interesting than you could possibly believe. Mark's also a top-end photographer, and so some of the imagery is going to be absolutely fantastic. Anyway, enough about that. Really, the real thanks have to go to you, Julian. You very kindly suggested that you'd like to cover this topic. I was thrilled, and I've always enjoyed working with you over the years. Unfortunately, I'm unable to, using the technology, give you a proper round of applause or anything like that. So at these FS Club sessions, I traditionally bring out my little Buddhist applause meter, my karmic clapper, if you will, and I'd like to thank you very much on behalf of the audience.
Thank you.
And I would hope that there's a chance we might be bringing you back quite frequently if we're successful at getting this Resilience Re model moving. And I suspect, given the comments here about the full support of our club, you and Stephen, to get all that happening. But unfortunately, I have to bring this to a close. These always seem terribly abrupt. But goodbye to you, Julian. Goodbye, one and all. And hope to see you all soon.
Thank you. Bye-bye.